What if I told you there's two ETFs that not only pay monthly income, but have outperformed the market as of recently while doing it? These aren't your typical dividend ETFs. They use options. They beat the market and they pay you every single month. Today we're going to be talking about ETFs from Amplify ETFs. They have delivered expanded investment opportunities for investors seeking growth, income, and risk managed strategies. The first ETF on our list is going to be DIVO, the Amplify CWP Enhanced Dividend Income ETF. Now, there's a lot of covered call ETFs out there, but this one in particular has been out since 2016, which is almost 10 years. This ETF is comprised of high quality, dividend oriented stocks along with covered calls on individual stocks. Because of that combination, holding high quality dividend stocks and selling covered calls on those stocks, you're going to have a high monthly income. We do have to note this is an actively managed portfolio, which allows the portfolio manager, CWP, to identify opportunities and risks and act on those decisions in real time. Now, because this is a very defensive ETF, we have dividend oriented stocks as well as selling covered calls on those stocks. We are seeking to lower our volatility, and that is particularly good in recessions when volatility is very high and you want to defend your portfolio a little bit. Dividend and option income may provide lower share price volatility versus the overall market during times of broad-based market declines. So DIVO is probably the perfect ETF to have in your portfolio during very uncertain times such as these. And in return for this excellent ETF, we are going to be paying the fund managers an expense ratio of 0.56. Compared to some other ETFs such as YieldMax or Roundhill ETFs, you're going to be paying close to 1% expense ratio. So seeing an expense ratio of 0.56% is seemingly high, but compared to other ETFs in this space, it is pretty low. And the best thing about it, Morningstar has actually given this ETF a 5-star rating as of March 31st, 2025. And if you're not familiar, CWP just stands for Capital Wealth Planning. So let's go over the objective and the strategy. The DIVO invests in high-quality U.S. large-cap stocks with strong fundamentals. This fund writes options selectively, not across the entire portfolio, to boost its dividend yield. This strategy generates consistent monthly income while maintaining upside potential. And if we take a look at the dividend yield as of March 31st, 2025, we can see it is distributing monthly dividends at a rate of almost 5%. Now, this distribution rate does seem pretty low, but considering it has excellent share price appreciation, you're getting very high total returns over the long run. Now let's take a look at the fund holdings as of April 21st, 2025. We can see the top 10 holdings include companies such as Visa at 5%, Caterpillar, CME Group, Goldman Sachs, American Express, JP Morgan, Microsoft, Home Depot, IBM, and Honeywell. And we can see there's no more than 5% in any one holding. And if we take a look at the rest of the holdings, we can see these are very recognizable companies. We have Procter & Gamble, Apple, McDonald's, Meta, RTX, which is just Raytheon. Yeah, very solid companies in this portfolio. So we can see this portfolio leans heavily into the healthcare, consumer staples, and industrial sectors. And it avoids highly volatile sectors to reduce downside risk. These sector choices help DIVO perform better in down or sideways markets. Now, with any ETF, it does have a selection methodology of what its holdings are. So it has dividend growers. DIVO is managed with a strong emphasis on owning high-quality, large-cap companies with historical dividend and earnings growth. Sector allocation. DIVO is relatively balanced among the traditional 10 S&P 500 sectors, with CWP determining which sectors to over or underweight based on various factors. Of course, we have security selection. It has 20 to 25 stocks, which are screened aggressively, adjusted to its attributes, and it takes into factor market cap, management track record, earnings, positive cash flow, and return on equity. So we're seeing this ETF is very strict, similar to SCHD, which is very picky on which holdings the ETF has. So this is a direct competitor to SCHD with its excellent dividend track record. And then of course we have tactical covered call writing. We do have a video on what covered calls are. It will be linked down below. But basically they're writing covered call options on individual stocks. Now, unlike other ETFs, they are picking and choosing which stocks in their portfolio that they're selling covered calls on that they think are great opportunities. They're not selling covered calls on every single holding like many of these other covered call ETFs, and that's what makes this ETF very special. And if we take a look at the sector allocation, it is very diversified among the 10 sectors. Now let's take a look at the performance. Since inception, 2016, it has had a share price appreciation of 56%, and that is not counting the dividends. If we go to totalrealreturns.com, we can see that it actually has an 84% total return with dividends reinvested. And that is a solid return for a dividend-focused ETF in only 9 years. If we take a look at the dividend history, it is down a little bit, so we are having a 5% dividend yield, a pretty solid buy at this price point of $39 per share. That pays out a frequency of monthly, and we can see very consistent cash flow every single month. And it's been having a dividend growth rate of almost 12%. So right now, we're pretty much getting about 16 cents, soon to be 17 cents per share every single month. Now let's divert a little bit and go over QDVO, which is another ETF by Amplify and is the Amplify Growth and Income ETF. This is a relatively new ETF. It was released August 2024, so it hasn't even been a full year, but a lot of people are liking its performance so far, and if people want something more aggressive, they are leaning towards QDVO. So why invest in QDVO? Well, QDVO is holding high growth, large cap US companies along with strong cash flows. And then, of course, just like the other ETF, it selectively writes covered call options to monetize volatility and create premium income. This gives investors the best of both worlds, growth and income yield. And it has a very similar expense ratio of only 0.55%. Let's go over the dividend yield. This is why everyone loves QDVO as of lately. Of course, we have those monthly distributions, but we have a very high distribution rate of over 10%. So in addition to the strong share price appreciation, we're getting 10% distributed monthly, which is a very nice thing to see with an income ETF. So let's take a look at QDVO's sector focus. We can see the top 10 holdings include companies such as Nvidia, Apple, Microsoft, Alphabet, which is Google. We have Amazon, Meta or Facebook, Netflix, Tesla, Broadcom, Visa. So this is very tech oriented, very tech heavy. As we can see, we have almost 9% in Nvidia alone. So this is going to be a more volatile ETF. And this is perfect for people who have a long time horizon, who can withstand volatility in order to receive higher total returns. So let's take a look at QDVO's selection methodology. This one, unlike the other one, has growth equities. It has a portfolio of large cap growth equities with historically strong earnings and cash flow characteristics. So there's no meme stocks in these portfolios. These are large cap growth companies. And then we have sector allocation, relatively balanced across a variety of the sectors, determining which sectors to over and underweight based on various factors. This portfolio consists of 20 to 40 stocks, screened aggressively and based on attributes that they believe are attractive, including earnings growth, cash flow, and relative performance. And of course, we sell covered calls on these holdings. Now, if we take a look at the sector allocation, a huge chunk is going to be the information technology sector, and that is going to allow us over the long run to have that share price appreciation that we know and love. So if we take a look at this ETF, there's not much data we can see because it only was released in August of 2024. So share price appreciation, it is down 5%, and that's because tech and the overall market has taken a huge hit. We can see up until that point, it did have that nice share price appreciation, but you are going to drop with the market because you're very tech heavy. And the best thing about this ETF is you're still going to receive those monthly distributions in the form of dividends because we're selling covered calls on very volatile stocks. That's why we have a higher dividend yield. Now, if we take a look at the total return since inception, August 2024, it actually has a total return of negative 0.84%. And that is almost on par with DIVO, which is a lot less volatile ETF. But because we don't have as high monthly dividends, QDVO has made up some of that loss with its tactical covered call writing. And if we add the S&P 500 index into this mix, we can see that the overall market is down 6%. So both of these ETFs are severely overperforming the market by a huge margin. And if we add QQQ, which is a tech sector, and is based off of QDVO, we can see it's down almost 8%. So QDVO is a very attractive choice for a lot of investors for that income and that growth. And it has been beating the market, especially during times of recessions. And if we take a look at QDVO's dividend history, it does show 5.7%, but that's because it doesn't have a full year of dividends, so this isn't accurate. But we can see the cash amounts that it has been paying out, and it's between 15 cents and 20 cents per share. And considering that we have a share price of $23, that is almost close to 1% per month. Because remember, if we own 100 shares of this ETF, we're going to be getting about $20 every single month. And that is almost enough to buy a single share every single month of this ETF. So who should own QDVO? This ETF is ideal for investors who want exposure to growth stocks, but also want monthly income. It's a great complement to traditional growth ETFs or dividend funds like SCHD, or even a great complement to DIVO in your dividend portfolio. DIVO prioritizes dividend stability and low volatility, while QDVO, the growth and income ETF, leans into growth potential and tech exposure. So together, they create a balanced income growth hybrid portfolio. And in today's volatile market, combining yield and growth is more valuable than ever. While this ETF is very new, DIVO has proven itself as a solid dividend ETF.